Hi everyone, and thank you for joining QuotedData on this glorious day. Today we are joined by the managers of Downing Renewables Infrastructure Trust, which, as you may be aware, is aiming to raise 50 million through an issue and to establish a 12-month share issuance programme. The fundraise is available on various platforms, including AJ Bell, EQI, Hargreaves Lansdown, ID Link, Interactive Investor, Primary Bid, Redmayne Bentley, and Walker Cripps. So I'm joined today by DORE's managers, Tom Williams, Tom Moore and Henrik Dahlstrom, who will discuss DORE's performance today and why now is the right time for a capital raise and the exciting pipeline of opportunities for the Trust. Thank you for joining me, guys.
Well, thank you so much for having us, and thanks also to everybody who's joined us. So thanks very much. My name is Tom Williams. I'm the Head of Energy and Infrastructure here at Downing. As we mentioned, we're also joined by Tom Moore, who heads our asset management business, and Henrik Dahlstrom, who's an investment director with a particular focus on the Nordic region. There are a few important notices, so please, if you can, take a little bit of time to have a look through these. And we just wanted to start off with a quick reminder about Downing. So we are a niche investment management business. We have some areas of deep focus, and this is very much one of them. We have been investing in core renewables for more than 12 years now. We've done more than 170 transactions, and we have more than 40 people focused exclusively on this space. Around half of these people work in our asset management business. That is a business that Tom runs, as I said, which focuses solely on preserving and enhancing value of the projects that we invest in. The balance work in our investment team, and also work in a business which develops new projects solely for the purpose of offering them for investment to our funds. Why are we talking to you today? Well, two reasons really. One is to give you a bit of an update on how things have gone over the last 15 months, and specifically how things have gone in the last quarter. But also to talk to you about what we're really excited about, which is growing the fund. And why are we growing the fund? We're growing the fund because we've spent all the money we have. And we have a very large pipeline of opportunities, actually many times the size of the fund, about 4 billion. We constantly run around about 3 to 5 billion worth of assets of opportunities, and we can only ever do a fraction of that large pipeline, and it is a fraction of that large pipeline where we have progressed to an exclusive or a bilateral stage, around 200 million or so of opportunities, and we're looking to raise 50 to invest in those near-term opportunities. We've got some details of the offer here. I think the critical thing is it's a small discount to the share price the day before we announced the offer, and a small premium to the net asset value most recently announced at March. We do have a little bit of time still to run. The offer is open until Tuesday next week, but not too long. And so all the relevant dates are here on the slide for you. Now, talking about how we've done over the last 15 months or so, the short answer is we've exceeded expectations. So we have returned 16% to shareholders over 15 months. That's a combination of NAV increase, so increase in the capital value of the fund, and also an increase in dividends. How have we gone about those achieving those returns? It's by the assets that we have invested in producing more units of energy than we expected, and also making more money per unit of energy, so the operating profit is higher. We've also managed to, by virtue of the strategy that we have, invest in projects that have been accretive. So they've added to the capital value of the fund. We'll talk you through why that's the case. That's looking backwards. Looking forwards, I think it's equally exciting. And why is it exciting? It's exciting because we are in unprecedented times in the economy. We have very significant inflation. I saw even today that the Bank of England is thinking that inflation is going to be higher than they originally thought this year. Inflation is good for this fund and good for other vehicles in our sector. Why is that? It's because we have a very significant portion of our revenues, about 44%, that are directly linked to inflation, particularly UK RPI. We're also in a period where we have very high power prices, as I'm sure we're all aware from our own electricity bills. Those power prices are driven higher by gas and by the price of carbon emissions. Our portfolio does not use gas to produce energy, and it doesn't emit carbon, and therefore, to the extent that the prices are being driven higher by that, that is additional revenue for our assets. We also, in a time where inflation is high and interest rates are rising, we've also taken the precaution of fixing our interest rates, so we have no interest rate exposure until 2034 on our long-term borrowings. So the flip side of this is also well dealt with. One of the other achievements that we've managed over the past 15 months is to achieve an Article 9 designation for the purposes of SFDR. So what does this mean? It means we are an impact fund. We have a core sustainable investment objective, and that objective, put very simply, is to accelerate the transition to net zero through our investments. We do take this very seriously. There's an awful lot of disclosure and reporting about this in our annual report. So I really would encourage you to have a look at that if this is something that is of interest to you. What we thought we'd do here is try and put the fund and the fund strategy in the context of what is going on in the world around us. The transition to net zero is something that is of common policy goals on both sides of the aisle in all of the countries that we invest. So there is unified and aligned policy and all the main political parties. That means that all of our target markets are anticipating more renewables in the future, and so our market is growing. What is also happening is demand for electricity is growing. And why is it growing? It's growing because as part of that transition to net zero, we are electrifying other parts of our industry and our economy. Things like transport, so EVs, things like heating, which is a huge consumer of energy, and also data. What is probably just as big a concern for governments right now is also security of supply. So thinking about where we source energy from, and in particular the fact that we source energy from a variety of unfriendly places around the world. So with the invasion of Ukraine, what that has brought into very, very sharp focus is that we should be rolling out more renewables, because that is the thing that we can do most quickly to increase the generation of electricity from within our own borders. All of these things are pointing towards more renewables, increased intermittency on the grid, which is very much a driver of value and integral to our strategy, and increased interconnection in markets, which has an impact on how we think about things and where we invest. And so this all feeds into the fund strategy. And that strategy, put very simply, is around diversification. So it's self-evident. If we are looking at a number of different technologies in a number of different locations, we will see a broad set of opportunities, and you can see that in the numbers that I was talking about earlier. What diversification also brings is increased stability of earnings, we hope, by having a variety of different revenue streams, a diversified set of revenue streams. So we think we can increase the quality of earnings and de-risk our return to investors in the future. Why do we think that? Well, if you think about what we're investing in, each one of those technologies is dependent on a given natural resource, the sun, the wind, and those natural resources are seasonal, they're intermittent, and they're variable. We think it's not a good idea to have to be overly reliant on any given natural resource. So we think you should have a spread of exposure to those natural resources. And if you move geography, you can access different natural resources and therefore different technologies. What you can also do when you move geography is you can invest in different energy markets. So you can sell your units of energy into a different market with a different set of drivers and therefore different outturn pricing, different long-term outlook. If you combine those different technologies in different places with projects at different stages, then what you get is that diversification of revenue stream and that long-term stability. Now, this is a slide here which tries to talk to you about how different these different technologies are. So this is the portfolios that we have, the assets we have in the portfolio. The different dotted lines are different technologies. Green is solar. The two different blue ones are wind and hydro. It's months of the year on the bottom and percentage of annual generation on the y-axis. And what you can see with that solid orange line is how much more stable the production is, the generation is throughout the year when you combine all of the assets together. And that is throughout the year and year to year. And this is particularly powerful when you combine these assets, if these assets have generation profiles that are not correlated to one another. And this is what we're showing you here. So this is big data. It's different technologies in different jurisdictions. And what you can see is that the solar is not correlated to anything. So it shows a negative correlation. And then what you can also see is varying degrees of correlation between these different types of technologies in different locations, none of which are particularly meaningful until you get right down to the bottom there on the right hand side, where you've got a common wind pattern between Ireland and the Nordics. And I talked about how powerful it is to be selling your units of energy into different markets with different drivers, and what we're showing you here is just how different the drivers are between the GB market and the Nordic markets. The GB market, like continental Europe, is a predominantly gas-driven market. So the price of gas and the price of carbon drive the price of power. In the Nordics, that's not really the case, actually. So with the predominance of hydropower, it's actually hydrology that sets the price, along with wind, which has a significant influence. So I've recapped the strategy for you. I think it might be helpful now for us just to take you through what exactly it is that we've invested in over the past 15 months. I'll hand over to Henrik, who'll take us through that. Oh, I think Henrik might have lost his sound. So while Henrik just recovers, I'll take you through the portfolio here. So
can you hear me now?
There we go.
There we go. Sorry, there was something wrong with that. Yeah. Good morning, everyone. On this map here, we've set out an overview of the assets that we own. So in the UK, we got a solar portfolio. It's ground mounting in Great Britain and rooftops in Northern Ireland. Then in Sweden, we have a wind farm up in the northeastern part of the country, and then we also have 19 hydropower plants in the central part and the southern part of the country. And what's worth mentioning once we're on this slide here is that in the Nordic countries, the countries are divided into different price zones. So in Norway, for example, you got 5 different price zones. In Sweden, you got 4 different price zones. Price zone 1, SE1, is the furthest north, and SE4 is the furthest south. We cover 3 of these price zones. So we have the wind farm and 5 of our hydropower plants in the SE2 part. We got 12 hydropower plants in the SE3 part and 2 hydropower plants in the SE4 price zone. And the feature of these different price zones is generally speaking, the further south you go, the higher the power price is. And that's to do with transmission bottlenecks within the country, but also the fact that in the southern part of Sweden, you also have export cables going to Denmark, Germany, continental Europe, which tends to drive up the prices in the southern part of the country. The hydropower portfolio in specifically, we have 19 hydropower plants mentioned, forecast annual average production 174 gigawatt hours. We bought 8 of these hydropower plants in February last year, and that was a transaction from where we bought these ones from Fortum. These hydropower plants, they are in the SE2, SE3 price region. They come with significant storage capacity. By storage capacity, I mean reservoir capacity, which is effectively lakes that you can regulate the water flow from. This was a carve-out from Fortum, and so Fortum provided a transitional services agreement that meant that they operated the assets for us up to 12 months. So we were busy last year recruiting people locally to actually manage these assets on a day-to-day basis. Locally in Sweden, so we got people locally in Sweden who's looking after this on a day-to-day basis, and we also have various third-party contractual arrangements, for example, in relation to O&M and dispatch of water. We also put in place a debt package. We made the initial acquisition unlevered, and that was to reduce cash drag at the portfolio level. We put in a debt package during the course of last year. A 7-year facility. We drew down on that 7-year facility to acquire 2 more portfolios in January of this year. 9 hydropower plants, similar type of geography in the SE2, SE3 price zones, and also these assets also came with additional reservoir capacity. And finally, we bought 2 more hydropower plants just over a month ago in May. That's down in the SE4 price region, where the power price is the highest. What we can say is that these transactions, they're predominantly bilateral, so they're relatively small, these add-on acquisitions we made this year, so they've been bilateral. The fact that we set up a standalone business entity last year means it's relatively easy for us to add on more hydropower plants into that portfolio. And whilst we do that, we can then take advantage of economies of scale and efficiencies from having that larger portfolio. And also, the fact that we have a sizable portfolio means that we have a relatively efficient capital structure to benefit from as well. These acquisitions, they've been accretive. 2 of them have gone through our valuation cycle and come out accretive as part of that, and the third one that we acquired in May is yet to go through the valuation cycle. But we've made a statement. We think that it's likely to be accretive. In terms of the solar portfolio, that's a portfolio we acquired in March last year, £42 million, just over 3,000 operational solar PV installations across the UK. They've been operational for about 7 years, so had a good track record when we bought them. 86% of this portfolio benefits from a PPA floor, and that's good when power prices are low. However, at the moment, power prices are high, and as Tom mentioned earlier, we have a direct linkage in this portfolio to the UK inflation. So about 60% of the revenue of this portfolio is directly linked to UK RPI. So this asset benefits directly from high inflation. And then finally, in February of this year, we paid just under £20 million for a wind farm in northeast Sweden. This one has been in operation for about 10 years. It's 20 Enercon turbine, 46 megawatt onshore installation. And this was really exciting for us. That meant that we had a new technology into the portfolio. So we now have investments in the 3 core renewable energy technologies. So if we look at the chart on the next slide, we see how the portfolio generation breaks down on your left there, where you have generation by technology. So just under 50% comes of the generation comes from hydro, and the residuals split across solar and wind. You can also look at this by looking at the generation by power market. You can then see we cover 5 different power markets, 3 in Sweden. We got the GB market, and then we also have the Irish market, which is a separate market. This is done by generation, and when we do it by revenue, it would look different, and that's because the power prices in these markets are quite different. And as you can see in this chart here on your right, the power price for the UK and Ireland, that's at the top. That's the blue and the grey lines there, so significantly higher than the Swedish power markets, but also within Sweden, the SE4 market significantly higher than the SE3, SE2 markets. These are the power price forecasts we used for our March valuation. So of course, there are new power price forecasts coming out all the time. And this is what was applied in that valuation. As you can see here, the power prices forecast to come down over time, apart from in the SE2 price region where they're expected to come. And also over time, power prices are expected to converge, and that's as a result of having increased transmission within countries. So within Sweden, you will see bottlenecks being resolved, but also additional interconnectors between countries, bringing countries closer together. Also, what's expected to happen over time is that as countries roll out more and more renewable energy and become less reliant on gas, the merchant power is expected to be more set by renewable energy sources than gas, playing a part of that convergence. So, benefits of hydropower. Why do we like hydropower? Recognize that not everyone is necessarily all tuned into the benefits of hydro. So we try and summarize that here. We put it as 4 different features. First one is that hydro has high load factors. Second one, hydro comes often with storage, which allows you to optimize your capture price. It's also expected to come with future growth in your net asset values. And finally, can assist you with your hedging arrangements across the portfolio. So if I take one at a time here, high load factors, that simply means you produce a lot more hours in any given year than other technologies. So you can see in the chart at the bottom there, we produce about twice as many hours in a year compared to wind with the hydro portfolio, and about 4 times as many hours compared to solar. In terms of storage, our portfolio has about 120 million cubic meters of storage capacity. Having this storage capacity, that allows us to regulate our production and produce more when power prices are high. And that's hydro is really the only renewable energy technology we can do that with. It is similar to a battery though, but a battery is something that you charge up when power prices are low. You use that charge for an hour or 2 maybe when power prices are high. You have to then wait for power price to come down before you recharge it and can sell it again. Hydropower is different. You have a much longer duration. You can keep going for many hours or days if power prices are high, or even weeks. So that duration and storage is much more flexible than than a battery would be. Then, in terms of net asset value growth, some of these assets that we own, they have been around for 80 to 90 years. They're expected to be around for at least that going forward. Hydropower is seen as perpetual assets, and that's different to solar and wind, which have finite lives. So after say 40 years, those assets have a value of 0. Hydropower been around for a long time. The assets are underpinned by freehold ownership of the land. The permits have perpetual water rights. And then, of course, you'd need to spend your maintenance capex to make sure that the assets are in good working condition, but that's built into your investment cases. You can do those studies at the start. The NAV is expected to go up as power prices over time are expected to go up. both in real terms, but particularly in nominal terms, the power price is expected to increase over time, underpinning that future NAV growth. And then finally, assist with the baseload hedging across the portfolio. So this is a little bit complex, so I'll use a minute or so to explain. If you have a large concentration of an intermittent technology, such as wind, that may result in you having a below average capture price. If you have, as most people do these days, have baseload hedging, that means that you effectively hedge out a profile every hour of the year, knowing that you will produce some of those hours, but not necessarily all, because the wind doesn't always blow. That may expose you to a mark-to-market arrangement if the power price is higher and you are not producing in those hours. But by combining technologies, you can really save money by combining the technologies in the same pricing. We tried to set that out in this chart here. It's a little bit of a busy slide, and I'll focus on the top two charts. What you can see in the top left chart there, the power price in SE2 is the red line, and that's a couple of spikes. And we picked up 2 weeks where the price really spiked. And the production from our wind farm is the gray line, and the production from our hydropower plant is the blue line that goes across. So as you can see here, in the first few days there, the production was high in the wind. It benefited from that baseload hedge. And then when there were a few of the spikes, the production from the wind farm was low. And it was exposed effectively to a mark-to-market on the power price production in those days, those hours when it didn't really produce much. However, on a portfolio level, we were well covered because our hydropower plants were producing constantly throughout this period. So the hydropower captured all those peaks that we saw in this particular week. That's really a message on how you can save money by combining technologies, hydro with an intermittent technology. The second chart on your right there, that is when we've exited out of the transitional services agreement in full. We have taken a bit more control of the operations on our hydropower plants. And as you can see, the blue line is not just horizontal, it goes up and down. We have regulated our production in order to try and match the peaks of the power price. And as you can see, we did a pretty good job in doing this. We had a capture price that was much higher than the system price. We didn't get it perfectly right in every day, but a pretty good outcome in terms of matching those high power prices with our production, regulating our production to do so. And that's really a message on how you can make extra money by using your hydropower efficiently in its markets. I'll stop there and hand over to Tom.
So sorry guys, just before we move on, we've had a few questions just on hydro again. You have a lot more compared to other trusts in the sector. Why do you think maybe your peers haven't gone into hydro in this sort of similar way?
I think it's a couple of things. So one is that a lot of people have a mandate that's more restrictive than ours. So they might be focused on a specific technology in a specific jurisdiction. For instance, there might be a UK wind fund or a UK solar fund. Or so I think historically that might be why. I also think that from our perspective, this is something where we've spent a lot of time and a lot of effort focusing on this particular sector. We've tried very, very hard to build up a portfolio here. We've again, unlike others, we've established a presence in Sweden. We have an office in Sweden. We have now, I think there's 6 people in that office, and so we have boots on the ground, and we have people that are scouring the market, sourcing these kinds of transactions. I also think that there are more of these kinds of assets in Scandinavia for obvious reasons. 50% of Sweden's generation is it's from hydropower. 95% of Norway's electricity generation is from hydropower. So when I was talking about earlier that when you move geography, you can access different natural resources. Well, the topography of those countries is just much better suited to hydro than the UK. We have relatively little hydro resource, and that is concentrated in Scotland and in some parts of Wales. So again, by having that different geographical focus, we're able to access more of these kinds of these assets. And then, as much as I hate complimenting Henrik at all, I think he also does quite a good job of finding these opportunities and bringing them into the portfolio. So maybe it's a combination of all of those things.
Sure. And we've had quite a few questions about whether there will be plans to invest into other geographies or other technologies. We've got a few questions about construction stage assets or energy storage.
Yes, absolutely. So, well, first of all, I think on the storage front, I think what we're saying here, and in particular, looking at that chart on the right-hand side here, is that actually we have an enormous amount of storage. We have 120 million cubic meters of storage in the portfolio, which is the water in the reservoirs that we can control, we can regulate. And we think that is a far superior form of storage because of the duration, because of how long you can run the turbines in the hydropower plants with that water, where we can not, the commercial batteries are, 1 or 2 hours at the moment of duration, and then you have to charge them back up again. The reservoirs that we have can run our turbines for weeks and months. So if you have sustained periods of high pricing, you can really take advantage of that, and that is not possible at the moment with large-scale batteries. You need volatility for large-scale batteries. But having said that, we also like batteries. In fact, Downing has had a long association with batteries, particularly in the UK. In fact, we were one of the first movers into the space. We don't have any in this fund. We do manage another fund that has batteries, and we're actively looking at opportunities in the battery space in both the UK and in the Nordics.
Brilliant, thank you. And sorry, just quickly before we move on to Tom, what do you think about geothermal? Would you hold any, and which jurisdictions do you think would be best for this?
Well, again, geothermal is quite specific to location. You need a particular type of natural resource. We are quite actively looking at opportunities in Iceland at the moment, where there is an awful lot of that kind of resource available, and we absolutely would have geothermal. So geothermal is, we talked about hydropower producing lots more hours of the year than other technologies like our wind assets and like our solar assets. Geothermal produces for even longer, even more hours in the year. So it's closer to baseload production. So it's very attractive. So absolutely we would do, and absolutely we aspire to. Yes.
Great, thank you.
Perhaps what we can do is, I know it's great. There's quite a few other questions. We'll try and pick some of those up as we go along.
Yeah.
Tom.
Thank you. Good morning, everyone. So Tom mentioned earlier the asset management team. Downing have invested an awful lot of time and money in building that team. That stands at about 20 people today across London and Sweden. They offer a full scope of services to the underlying portfolio. So job one is to protect the portfolio and our investors from any downside, be it operational or financial. Job two is identify opportunities for optimization and improving returns wherever we can. And we do that through a full suite of activities. On staff, we have engineers, electrical, mechanical, civil, we have data scientists, we have commercial experts, regulatory experts, and accounting team as well. Part of what we do is focused on ESG. Fundamentally, at a very practical level, we see a great responsibility in the land and the waterways we manage, and we spend a lot of time working with local stakeholders to making sure we have a positive impact wherever we can. So that could come through working with local charities, local educational groups, to help them learn and understand how these systems work. We work with local wildlife or biodiversity experts to enhance local habitats for endangered animals. And we work with our operators on a daily basis to make sure that the contractors and the public and residents around our sites are safe. The focus on ESG comes from a desire to be as transparent as we can through the reporting. We were one of the first in the peer group to report under TCFD, and that's in our annual report alongside our scope 1, 2 and 3 emissions. We have some really positive engagements on that level of reporting, and I'm more than happy to talk to them about that. Moving on to the NAV growth we've seen. So we've had 5 consecutive periods now of outperformance of the underlying portfolio. That performance has supported the decision for us and the board to bring that dividend guidance forward. We paid more dividends than we were expecting at IPO, and those dividends have been covered, were covered last year 1.2 times in cash, and that more cash generation from the underlying portfolio is supporting that. We're not taking all the credit for this NAV progression. We've certainly been helped by rising power prices, rising levels of inflation, but you can see the acceleration of that towards the back end is the new acquisitions being brought in, and on an accretive basis to NAV and accelerating that growth more recently. And we have returned on a NAV basis 16% to our investors since our IPO. What you see on this next slide is the NAV bridge from our December announcement to our March announcement. So the March announcement took us to an NAV of 110.1, and that's about 150 or just over 150 million pounds. Gross asset value sits at a little over 250 million pounds. And you can see the individual drivers here between the December and March NAV. So the red columns on the left-hand side, those are the fund level costs and dividends, reducing the NAV. And then you move into the green columns, which are our underlying investment valuations and their contribution to that progression. So outperformance, the diversification of the portfolio really coming through this quarter. The wind assets slightly below our expectations for that short period of ownership, but more than outweighed by the positive contribution of the solar and hydro portfolios. That power curve, that's just us moving to our forward power curves from our advisors in each of the price regions we work within, and inflation there continuing to benefit from rising inflation levels. We haven't adjusted our long-term inflation levels, so in the UK we're still at 2.75% for 2023 and then 3% thereafter. In Sweden we're under 2% in the long term, so we think there might be a little bit more to come there. FX exposure is limited by our hedging strategy, so we hedge both yield from the underlying investments over a 5-year linear reducing scale. We've also got a significant amount of our euro exposure on the NAV and the investment valuations hedged as well. That exposure is in euros. We do have some local currency costs in SEK, but the vast majority of that exposure is to the euro. The last column there on the right hand side is the accretive acquisitions we're bringing in, and that is the benefit of buying better price, smaller hydro assets and bringing them into a more efficient and larger platform. About 2.2 million of the 5.3 came from the wind asset, and the remainder from those hydro acquisitions. And as Henrik mentioned earlier, we haven't yet brought in the acquisition from May into that, but we have announced that will be accretive to NAV when it is brought in. The next 3 slides show the same bridge but by different technologies, and you see a very similar picture across all 3. So the outperformance there on the hydro portfolio, that's our ability to generate when the power prices are high, and that storage capability coming through. Again, higher power prices and inflation, and those acquisitions really helping. Similar story across all these 3 slides here, but the diversification really coming through to help. There has been an awful lot of investment activity during that first quarter, so we have republished and reworked our investment sensitivities. We published them here, updated from the annual report. those just reinforce the positive impact that inflation and power curves can have on this portfolio. And we haven't changed any of our discount rate or asset life assumptions, so we are still at 25 years, for example, for UK ground mount assets. That, alongside the discount rates we're using throughout the portfolio, puts us in a pretty good position when compared across the peer group. The weighted average discount rate we're using is 7.1%. I'm going to pass back to Henrik now to look at some of the pipeline opportunities.
Sorry, Tom, just on that, how sensitive are you to oil prices?
So more gas, obviously oil and gas is related in their pricing. But as Tom mentioned earlier, gas is driving, certainly in the mainland Europe at the moment, those power prices. So because we don't pay for carbon, we don't pay for gas to generate, our resource is free. We do benefit to a great extent from those rising power prices, especially in the UK, where that market is driven by gas and carbon pricing.
Sure, thank you. Just another question on why are you looking at buying a stake in offshore wind? Apparently these are now selling on very low implied discount rates. Can you buy UK wind assets at good value?
Yeah, it's I think selectively is the answer. There's two reasons why we're interested in the offshore wind asset, and we can talk about this a bit later, but it adds further diversification. So different weather patterns, different locations. They also have quite high degrees of fixed revenues for quite long periods as well. So heavily contracted revenues. So we do like that. It is a lower returning asset in the sort of scheme of things that we look at. But there's a place in the portfolio for all of these things. We're doing pretty well on returns at the moment. The assets are performing better and returns are better than we expected. And so we tend to look at these things as a whole when compiling a portfolio. So some things that we might buy might be slightly below our target, and some things will be slightly above, and overall we will deliver the overall target returns for the fund, which we're comfortably exceeding at the moment. I think the bigger question about that you've asked is an interesting one, right? Because at any given time in any given market, you tend to have types of investments that become more heavily competed for whatever reason, and the market heats up, right? So and with our strategy, the point here is that we're trying to have enough different markets and different technologies that we're targeting, so that if a particular market or a particular technology really does heat up, we don't have to invest in that. We can go and invest in something else and get better value elsewhere. And that will fluctuate over time as throughout the life of the fund. And so what we didn't want to do when we were setting up the strategy was be focus on a single technology in a single market, because then you've got no choice. It doesn't really matter whether your market's hot or cold. You've still got to go into it, and you've still got to make investments in that market if you want to grow. Or in some cases, actually, even if you just want to maintain your NAV. So you know, a lot of the assets like solar and wind assets, they have a fixed life. The cash yield you get off them, you have to reinvest a portion of it just to maintain the net asset value of your fund. And that's true for solar and wind. That's not true for hydro, because hydro is actually worth more in the future, not less. So it's another reason why we like investing in hydro, for example. And actually, that was what this next section is all about. Actually, it's about some of, first of all, the credit facilities, but actually about what that pipeline looks like, where we think interesting opportunities lie. So perhaps we could talk about that a bit. I'll hand over to Henrik.
Brilliant, thank you.
Yeah, thanks, Tom. So yeah, just a quick overview on the debt side of the fund before we go into those opportunities. At the moment, we have overall borrowing that stands just below 40% of the deemed gross asset value. That's similar to enterprise value. As Tom Moore mentioned, we don't have any debt at all in the Swedish wind farm. In the UK solar portfolio, we have just under £80 million of debt. All the margins here are fixed. There's no interest rate exposure. There's a bit of index linking going on in one of the facilities there. Downing Hydro AB, we raised a 7-year facility, 43.5 million euros with SEB. We drew down just over 27 million, used that for reinvestment into two of the acquisitions I mentioned earlier. We also have capital within that facility to cover any medium-term capital expenditure across the portfolio. Final point on that as well, we have swapped the interest rates here, long-dated interest rate swaps that go on until 2033, so beyond the tenor of the debt. In terms of at the fund level, we have the revolving credit facility. We've drawn down just below 70% of that one at the moment, and that was in order to finance the acquisition of the two last hydropower plants I talked about earlier. In terms of the overall pipeline of opportunities, we have identified currently a pipeline that's worth more than £4 billion. Now that's sort of a theoretical number to a large extent for us, given that we only need a fraction of this to keep growing. But what it does show is the breadth and depth of the markets available to us. That allows us to pick and choose which opportunities we go for, and that's both in terms of strategic, what type of assets do we want to own, and also where can we find good returning assets at accretive acquisitions. If we look at the current pipeline that is well progressed, we have more than £200 million worth of near-term opportunities that are either bilateral or exclusive, and that covers the hydro sector, operational hydro. We got an infrastructure asset in the Nordic region. We got some operational solar in the UK, and also the offshore wind in the UK that we just mentioned earlier. So if we take one sector at a time here, in the hydro space, we have 3 different projects that we're progressing. We have project 1 and 2 here, just around 20 gigawatt hours of generation assets, 2 different projects. Comes with additional reservoir capacity, and some of that reservoir capacity actually is upstream, so it happens to one of our existing assets, so we get the incremental effects out of that, the reservoir capacity to also benefit some of our existing assets. The third project set out here is we as an investment manager have secured an exclusive right with a local developer in Norway that constructs hydropower plants. They are to bring us at least 50 gigawatt hours of production opportunities over the next 3 years. They come to us when they are construction ready, so all the permitting and everything that goes on before that sits with the developer. We come in when they are construction ready, make a small payment at that point. Construction takes about a year. At the end of construction, we pay the residual outstanding amount, and after that's a fixed amount agreed. In terms of the infrastructure opportunity I mentioned, this is an electricity distribution network in the Nordics. It's a relatively small one, cable length just over 400 kilometers. Because this is a distribution asset, so the power cables into the homes, it doesn't have any direct linkage to merchant power prices, so it's a diversifier in that regard. It's also a monopoly asset. That means that we can't charge whatever we want to consumers, to customers. The revenues are regulated, so it's regulated by the equivalent of Ofgem here in the UK. These type of assets, they provide long-term stable cash flows. They're very long life assets, perpetual assets, are similar to the hydropower that we already have in terms of the NAV growth. But what is interesting with this asset is the inflation linkage. So this asset as well has a direct linkage to inflation, and the charges, the tariffs that this kind of industry sets are directly linked to inflation. So you do get another inflation linkage with this type of asset. We'll find attractive. I'll hand back to Tom to talk about the solar and the UK wind.
Yeah, thanks, Henrik. And actually, just just looking at a few of the questions that we've had, there's a question here saying, what technologies are you most excited about? I think Henrik has actually covered the ones that just now that we are. So I think we're really excited about the hydro assets. Why are we excited about those? We're really excited about those because of the possibilities that they have. We're only just scratching the surface of how we might be able to operate these hydropower plants and regulate that water differently from the previous owners, right? So the introduction of new technology, the ability to be able to regulate in real time the water flows, these are kinds of things that haven't been done historically in these assets, and that we're now implementing, and we really think the possibilities here are really exciting. And I think that's probably what we're most excited about, actually. Now, having said that, we're super excited about the hydro. We also like solar, so we've got some more solar here. This solar portfolio looks rather like the solar we have already. We like that a lot. Why do we like it? Again, long-term cash flows, lots of inflation linkage. So about 65% of the solar portfolio in the UK that we have already is directly linked to inflation. And so more of the same is very welcome, and it provides that sort of long-term stability and underpinning for the portfolio that we like very much. And offshore wind, we mentioned this previously. Why do we like it? It's that different weather pattern and those long-term contracted revenues. It is different. We normally take well, in the portfolio at the moment, we don't have any other minority stakes. We own 100% of everything, and we like that because we can control it. We talked about the 20 odd people in Tom's team, and we put them to work there to try and enhance the performance, the operational performance of the assets. So a bit more difficult to do that here, but interesting nevertheless for that diversification. Now, just to give you a feel for and a bit more detail on the economic environment we find ourselves in, and why this is driving such value, and we believe will continue to drive value in the fund. Well, first of all, power prices. So this is a distribution graph. It shows power prices over the last 10 years, calendar year ahead in the UK, and if it was 2 years ago, we'd just be talking about the box on the left there. That would be the whole graph. And where we are today is the box on the right. So we are just in uncharted territory. And even since we published our last NAV, which was to the end of March, power prices have continued to go north, continued to increase. So we also just wanted to show you what that composition of revenues looks like in the future. So this is the forecast from the latest valuations. You can see the dark blue there. That's the portion of the revenues that are directly linked to inflation. The balance is merchant power that is linked to inflation. Why do we say that? Because we say that because merchant power is a component of retail power. Retail power is the price that you and I pay for our electricity bill. That retail power is actually a component of UK RPI, in fact CPI. So it's a component of the way in which we measure inflation. So there's an inextricable link there. What you can also see in the dark green there is the result of our hedging programs. This is how we fix power prices into the future. We'll continue to do this. We do it about 3 years ahead in the UK, about 5 years in the Nordics, and then what we try and do is put in as much as we can of those sort of longer strips that you can see there of fixed revenues, which removes the exposure to merchant power and fixes the price that we can achieve for power. So really, that was it. Where are we today? Well, we just had a really good 15 months. The fund has performed extremely well. The assets have performed well, so it's been driven by the operational performance of the assets, as well as those tailwinds that I've just been talking about. We have a very significant pipeline. People have asked us here, it's actually two questions, interestingly. One saying, why do you only want to raise 50? And the other one saying, what happens if you raise more than 50? Well, I think we're picking around about that 50 number because that's what we think we can invest rapidly out in that that pipeline of the 200 million or so that we talked to you about, where we are in advanced discussions. So we've got to the point of exclusivity, or we're having those one-on-one discussions, those bilateral discussions that Henrik's been talking about. That's why we're going out for the number we're going out for. We don't want to raise so much money that we would then have cash drag on the vehicle and perhaps impact the dividends in the future. We were well covered last year at 1.2 times. We're pretty happy with where the dividend cover is at the moment. So that's also a factor for us.
Just continuing from that, Tom, we've got another question. What are your aspirations for the fund? How big do you think this could get?
I don't think there is a practical limit, to be honest, on how big the fund can get. Our aspirations for the fund are very ambitious. You might have seen we published the prospectus. The prospectus for this raise talks about a number of up to 250 million that we can raise in the fund over the next 12 months. So that gives you some idea of the immediate ambition, but I think the ambition is well in excess of that in the years to come. I see also we've got a few questions here about do we have any other offices or people in the Nordics beyond Sweden? So Downing manages other funds, and one of those other funds actually has investments in Norway and in Finland, actually. So we do have actually a spread of investments all the way across the Nordic region, and we have quite a bit of experience in those different markets. I'm just trying to look at some of the other ones here. You know, we've got a question about how dependent on rainfall are the hydro assets. Well, very dependent. The rainfall drives the water in the rivers. Water in the rivers then drives the power in the hydropower plants. Now we can regulate that, so we can look forward and decide. You know, we can work out if it's going to rain in the near future, so we can let more water out of the reservoirs, so that we top back up again with the rain. Equally, in this part of the world, the rain falls as snow, actually, so it's stored, if you like, over winter. And then what we get is a big spring flood where the melt happens and there's increased flow in the rivers. So it is absolutely all about the rainfall. You know, it's a good question.
There's been a lot of talk about generators having a windfall tax imposed. How much of this is an issue, if at all, to you guys?
Yeah, well, I suppose there's two things here. So first is we obviously have a very significant number of our investments outside of the UK. And when we talked about investing in different geographies, one of the points we made on that slide was also around being exposed to different policies and different governments. I think the second thing is a more fundamental thing, which is I just think that extending a windfall tax to renewable energy would be extremely counterproductive for the government. Why do I think that? I think that because it increases uncertainty. It will cause people to pause investments in the renewables sector, which is the last thing that the government wants right now. And because of that uncertainty and because of that perception of increased risk, people will want more in terms of return for investing in the sector. That means that the cost of capital will increase, and that means that if the cost of capital increases, the cost of power will increase, which again is not something the government wants. So I think it'd be extremely counterproductive. The other thing that is really interesting that the government's not talking about at the moment is that a very significant amount of renewable energy in the UK at the moment benefits from something called a contract for difference, or a CFD. What happens there is that you bid in government auctions. The last one was in 2019, and the strike price there was £40. So what that means is that if the power price that is achieved for units of power from that generation facility is above £40, the generator pays the government the difference. I did my own sort of personal back of envelope the other day. I think that projects that benefit from CFD probably paid the government about 1.5 billion over the last 6 months, and will pay another 1.5 billion over the next 6 months, 3 billion this year. The government's not talking about that very much at the moment, particularly because that 3 billion, I think, compares pretty interestingly to the 5 billion that they're trying to get from the whole windfall tax regime. So I'd imagine they'll be having some very, very interesting discussions with people who own CFD projects right now, because I think those people will be pointing out that they're already paying the government quite a lot of money. Sure. I think we got some other interesting ones here actually. You know, how do you source assets? You know, are these generally acquired off market, or do you get involved in competitive bidding processes? Well, I think Henrik gave you a feel for that earlier. Actually, it's a mixture. So some of these are in auctions, and we're pretty good at bidding and getting the assets we want in auctions. But also what we do try and do, of course, is try and acquire assets and source assets outside of the context of an auction. You generally tend to get a better result there, whether that's on price or whether that's on terms upon which you acquire the asset. Henrik gave you some background on it, just the last 3 or 4 acquisitions that we've made, the ones that we've made this year, which were actually mostly acquired in an exclusive or a bilateral process. And you can see from the fact that these are accretive, that you can, if you do that, buy them on attractive pricing. I think here we've also got some ones about, it looks like in the UK you're mostly solar, so what's your strategy to even out in the UK? I think it's to look at wind, is to look at batteries in the UK. So we absolutely have a plan to increase diversification within the UK portfolio. So I think that's again a great question. The policy is always to have a combination of assets in every market, and we think that is so powerful, and we think it's something that's very different about what we do relative to others. And if you cast your mind back to what Henrik was talking about in terms of those, the way in which you can save money and make money by combining assets with different generation profiles in the same market, that's what we're trying to do. How is energy policy changing in your key markets, particularly Sweden? I'll hand over to Henrik to give you a bit of background on the political and the regulatory backdrop in Sweden. But I think, you know, big picture, it's like every other market that we're investing in at the moment. People want more renewables. They want to accelerate the transition to net zero. Policies of all the main political parties are aligned on this point. And so there's only really one direction of travel here. But maybe hand over to Henrik.
Yeah, thanks, Tom. And obviously, it's a very good question. Probably could debate and describe this for an hour or something like that. But clearly, we do follow the energy policies, how they're evolving. Sweden has had a policy of expanding renewable energy for quite some time. It's coming from a background of having effectively an energy market that is split across hydro and nuclear. Nuclear is being decommissioned, and that's been going on for the past 20 odd years. The most recent nuclear power plant that was decommissioned was at the start of last year. Now there are more to be decommissioned. Whether they will be or not, that's a good question, or whether the life will be extended. Now we'll see, right? But what is probably more important is the stated aim of all the countries in the Nordics to be more integrated with the rest of Europe, and that comes down to interconnection cables, so exporting the power, to some degree also, of course, importing power when the conditions are reversed. Overall, this is positive for the region. The region has always had a discount in its power prices compared to continental Europe. Good example of interconnection cable that happened was the North Sea link that went from that goes from Norway to the UK. That came in place October, I think it was last year, and it's effectively a cable that 90+% is exporting power from Norway to the UK. That predominantly benefits Norway, but it has spill-on effects for the overall network as well. You have a similar aspect that you see in Finland as well, that Russia is stopping exporting energy to Finland, which then benefits northern Sweden in particular. We do keep on top of this. That these are countries that always have had a big focus on renewable energy, always will do, and they will continue to look to integrate with the rest of Europe, and that we think that as a whole that will be positive for making investments in this region.
Thanks, Henrik. So I think that's all of the questions done, actually. So maybe we'll hand back over to Jenna.
Brilliant, thanks all. Really interesting subjects there, and clearly a very exciting pipeline. Looking forward to see how the fundraise goes. And if any of our viewers want to participate, just a reminder of the platforms. That's AJ Bell, Hargreaves Lansdown, Interactive Investor, EQI, iDealing, Redmayne Bentley, Walker Cripps, and Primary Bid. Thanks again for joining us, Tom and Henrik, and to all the viewers, and hope everyone has a lovely sunny weekend.
Yeah, thanks ever so much, everyone. Cheers.